Hey, what's up, guys? It's your boy James Nas back again with another video on financial investments. Now, we all know that making money in the stock market is like navigating an iceberg. What you see on the surface is just a small portion of what's really going on underneath. And that's why I'm excited to share with you today my take on the financial investment iceberg. Trust me, you're not gonna want to miss this. So sit back, grab a cup of coffee, and let's dive in. Alright guys, let's start off by talking about the first layer of the financial investment iceberg. The basics, if you will. And what's more basic than a saving account? Saving accounts are essentially bank accounts that allow you to keep your money safe and accessible while also earning a small amount of interest. They are a great place to start if you're looking to dip your toes into the world of investing. But let's be real, the interest rates on these accounts is often pretty low, so don't expect to make a fortune overnight. Moving on to retirement funds. Now these are a whole different ballgame. Retirement funds are essentially long-term investment vehicles that allow you to save up for retirement. There are different types of retirement funds out there, but the most common ones are 401ks and IRAs. The key advantage of these funds is that they offer significant tax benefits, meaning you can save a lot more money than you would be able to otherwise. First up, we have money market accounts. Now, these accounts are very similar to saving accounts, but they offer slightly higher interest rate in exchange for a higher minimum balance. So if you're looking for a low-risk short-term investment option, money market accounts are definitely worth considering. Next up, we have a certificates of deposit, or CDs for short. CDs are essentially fixed-term deposits that offer high interest rates than most saving accounts or money market accounts. The catch is that you can't withdraw your money before the term is up without incurring a penalty fee. So, if you're looking to invest for long-term, CDs could be a great option. Moving on to the index fund. These are investment vehicles that track a specific market index, such as the S&P 500 that I already talked about in my videos. The great thing about index funds is that they offer broad market exposure, so you're not putting all the eggs in one basket. Plus, they typically have lower fees than actively managed funds. Now, let's talk about conglomerate stocks. These are stocks of large corporations that operate in multiple industries. The advantage of investing in conglomerate stocks is that they tend to be more diversified and less risky than investing in individual stocks. If you're looking for a stock investment option that's a bit more stable, conglomerate stocks are definitely worth checking out. And finally, we have government bonds. These are essentially loans you give to the government, and in exchange, they pay you interests. Government bonds are often considered to be some of the safest investment options out there, as they are backed by the full faith and credit of the government. Coming up with the layer 3, we have ETFs, or exchange-traded funds. ETFs are essentially a collection of stocks, bonds, or other assets that are bundled together into a single investment vehicle. They're traded like stocks, which means you can buy and sell them throughout the day. And they're a great way to broad market exposure with relatively low costs. Next, we have bonds. Bonds are essentially loans that you give to a company or a government entity, and in return they pay you in interest. Bonds are generally considered to be low-risk investment options, as they are typically more stable than stocks. However, there are also lower potential returns, so keep that in mind if you're looking for a higher risk investment option. Moving on to commodities. These are physically goods that are traded on the market, such as gold, oil, or coffee. Investing in commodities can be more complex than other investment options, as the prices can be impacted by a wide range of factors, including global supply and demand, weather patterns, and geopolitical events. And finally, we have stocks. These are probably the most well-known investment options out there. When you buy a stock, you're essentially buying a share of ownership in a company. Stocks can be volatile, as their prices can fluctuate rapidly based on wide ranges of factors, including company earning reports, economic data, and global events. Alright guys, we made it to the fourth layer of the financial investment iceberg, where things get a little bit more complex and potentially risky. First up, we have long options. Options are essentially contracts that give you the right, but not the obligation, to buy or sell an asset at a certain price within a certain time frame. Long options refer to buying options which can give you the potential for high returns if the price of the underlying assets moves in the right direction. However, they also come with the risk of losing your entire investment if the price doesn't move in your favor. Next on the list, we have futures. Futures are similar to options, but instead of giving you the right to buy or sell an asset, they require you to buy or sell the asset at a certain price and date in the future. Futures are often used by traders to hedge their risk or speculate on the price movements in commodities, currencies, or other assets. Moving on to angel investing, this involves investing in startups or early-stage companies in exchange for equity in the company. Angel investing can be risky but potentially lucrative investment option, as the companies you invest in may fail, but if they succeed, the returns can be significant. Real estate is another popular investment option in this layer. This can include buying and renting out properties, flipping houses for a profit, or investing in a real estate investment trust, short REITs. Real estate can offer a potential income and appreciation, but it also comes with its own set of risks, such as property damage or changes in the housing market. Coins and precious metals are another option in this layer. Coins can refer to cryptocurrencies or other digital assets, while precious metals include gold, silver, and other commodities. These investments can be volatile and may require a bit of research to understand, but they can also offer the potential of high returns. Here we go with the fifth layer. So first up we have cars. Yes, you heard that right. Investing in cars can actually be a lucrative investment option, especially for classic or rare cars that can appreciate in value over time. Especially for classic or rare cars that can appreciate in value over time. However, investing in cars can also come with its own set of risks, such as maintenance costs or changes in the market demand for certain models. Oh, hell no! Next on the list we have Forex, or foreign exchange trading. This involves buying and selling currencies in the hopes of profiting from exchanges in exchange rates. Forex trading can be high-risk, high-reward investment option, as currency prices can be volatile and affected by a range of economic and political factors. Moving on to the hedge funds, these are investment vehicles that pool money from multiple investors to invest in a wide range of assets. From stocks and bonds to real estate and commodities, hedge funds are often managed by experienced investors and can offer the potential of high returns, but they also come with higher fees and greater risk than traditional investments. Commodity futures are similar to other futures contracts, but they specifically involve the buying and selling of commodities such as oil, natural gas, and agriculture products. This can be a risky investment option, as commodity prices can be affected by unpredictable factors such as weather, political events, or natural disasters. Short options are the opposite of long options, meaning you sell the right to buy or sell an asset at a certain price within a certain time frame. This can be a way to profit from a drop in the price of an asset, but it also comes with the risk of unlimited losses if the price of the asset rises. Convertible bonds are another investment option in this layer, which allows investors to convert their bonds into a certain number of shares of the issuing company's stocks. This can offer the potential for both income from the bond and appreciation from the stock, but it also comes with its own set of risks. Mortgage-backed securities involve investing in pools of mortgages, with the income generated from the mortgages passed on to investors in the form of interest payments. This can be a way to invest in real estate without directly owning a property.
I am the way your son don't need a gun to get respect up on the street.
Margin is another advanced investment option which involves borrowing money from a broker to invest in assets. This can amplify your potential returns, but it also comes with the risk of greater losses and the need to repay the borrowed funds.
Tell them to bring me my money.
Royalty interests involve investing in the royalties earned from intellectual property, such as music, books, or patents. These can offer a way to earn income without directly owning the underlying property, but it can also be complex and difficult investment option. And finally, we have emerging markets. This involves investing in stocks, bonds, or other assets in developing countries that may offer high potential returns but also come with greater risks such as potentially unstable or currency fluctuation.